Hello everyone, friends. In this review, we will break down a metric called AVG. This is the most important metric for traders who consider themselves investors because it shows the long-term movements of the buyer's zone, which we will analyze now, and the distribution zone. Before we begin, let me remind you that we are on the trading platform Pro Service, which we developed ourselves. We analyze limit metrics that show the market's intentions, that is, looking into the future. So pay attention to the AVG metric. Let's start from the beginning. What does it show? AVG shows the average ratio across all Binance spot pairs at the depth we have selected, which in this case is 60%. Why am I talking about the depth we have selected? Because by simply clicking on the settings gear icon, we can easily select other specific depths: 15%, 30%, and 8%. And of course, the most significant and important depth for us is definitely the larger depth. Because if AVG shows us a long-term movement, it makes sense to consider only the larger depths, since the smaller depths do not reflect long-term movement. Smaller depths show what is happening in the market on a local scale, but larger depths do indeed reflect broader movements. Well, to explain it in simple terms, let's calculate the AVG for two coins, for example Bitcoin and Ethereum. Let's suppose that for Bitcoin at a depth of 60%, we have $300 million in USDT for buying and $600 million at a depth of 60% for selling. That is, there are Bitcoins worth $600 million. Accordingly, the AVG for Bitcoin will be 0.5 because 300 bids divided by the asks is 0.5. To calculate the AVG for Ethereum, well, we also need to know the bids and asks. Here, let's assume it's 150. That is 100 million in limit buy orders and 50 million in sell orders. 100 divided by 50 equals 2. The delta for Ethereum is 2. And to calculate the AVG of two coins, we need to add these two deltas and DV divide by their number. So 2.5 divided by 2 is 1.75. That means the combined AVG of the two coins is 1.75. We calculate for 400 coins, that is 400 Binance spot pairs. Right now, the AVG is 1.48. Here, we can already conclude that the AVG equals 1 when the number of bids and asks is the same. So for example, 100 to 100, that's 1, right? Accordingly, if the average delta of all coins is 1, then the AVG for the entire market will also be 1. And when it's 1.48, that means there are already more limit buy orders than sell orders. And so when an anomaly arises where the number of limit buy orders exceeds 1, that's exactly what we call the buyer's zone. Now look, I'll mark the level we're currently at, or even a bit below it. That's 1.50, an intermediate level. And when we were at such levels, it happened in 2019 during the Corona dump and at the end of the alt season in 2021, after which Bitcoin grew by 100%. It also happened in 2022, in the middle of the bear trend, and Bitcoin bounced back quite well by 40%. We saw the same values in this range as well, and Bitcoin bounced back by 20%, and the bottom of the bear market in June of 2022. After that, we saw an AVG similar to March 16th and June 7th. And all this tells us that in the future, of course, Bitcoin will strive to move from the buyer's zone, where we are now, to where? That's right, to the seller's zone. The seller's zone is AVG 0.5. Why? AVG 0.5 is the moment when the number of limit sell orders becomes twice as large as the number of limit buy orders. Let me remind you how we calculate AVG. First, in order to calculate AVG, we need to calculate the delta for each coin. So, if Bitcoin has 100 limit orders, $100 million for buying, and $200 million for selling, then 100 divided by 200 equals 0.5. That is, at that moment, there are twice as many limit sell orders. And so, when across all coins at the same time, across all spot pairs at the same time, our AVG becomes 0.5. That is, when there are twice as many people wanting to sell crypto as there are wanting to buy it at large depths, that is the point where the market starts to distribute. Now look, I'll mark AVG at 0.5, and let's see where the prices were at that moment. Here we had the mark, after which the alt season of 2021 ended its first wave of growth. Next. This was in September 2021, and we saw quite a significant drop of about 20%. That was the final growth in 2021, after which the market entered a bearish trend. Next, April 1st, 2024. And here it's not very noticeable on Bitcoin, but for altcoins this was a bearish trend. Well, for example, I'll turn on some altcoin, let's say ADA, and we'll see that ADA really did drop 50% from these levels. ADA dropped by 50%, even though Bitcoin was moving sideways. Next, so this is the entire range, right? Then, once again, we exited the distribution zone locally up to about the middle of the channel, so to speak, and then returned to the distribution zone. AVG again, or rather Bitcoin, was flat for a long time, and only then did it start to decline. That same ADA dropped another 60%. And before the dump from October 10th to 11th, for a long time, all summer until October, AVG was in the distribution zone, after which we saw a downward trend. What conclusion can we already draw from what we've looked at? That markets always move from the buyer's zone to the seller's zone. Here, the seller's zone is AVG 0.5. The buyer's zone, in our case, is AVG 1 and 5. These are global areas for buying and selling, which are more suitable for investors. But we'll go into more detail on this in a moment. But for now, to continue the topic, I'll note that the market always moves from the buyer's zone to the seller's zone, from the seller's zone to the buyer's zone, from the buyer's zone to the seller's zone, and again from the seller's zone to the buyer's zone. Next, as it happened in this case, from the buyer's zone to the seller's zone, and then from there back to the buyer's zone. And these periods are quite lengthy. In this case, it's 390 days. And in 2021, this process happened quickly. The entire growth lasted only 200 days. After that, the market grew from 2022 to 2024, and this lasted 700 days, which is almost 2 years. And it distributed for quite a long time, as much as a year and a half, and now it has come back to the buying zone again. So what does this mean? It means that this metric perfectly shows the points where investors and traders need to make their buying decisions, specifically investors. The main point is that this metric, since it looks at larger depths, is not suitable for intraday trading, because for intraday trading we look at smaller depths such as 8% or 15%. But in this video I want to convey the idea that the AWG metric at a 60% depth is an excellent tool specifically for people who wait for years for the right moment. Let's say to hypothetically sell an apartment and then after a few years make money from it, as is happening now, for example. Obviously, during the Corona dump, no one was buying when AWG entered the buyer's zone, and at the end, and during the alt season of 2021, when everyone who bought starting from February got wiped out. In general, everyone who bought over a long period got wiped out in just a week. And in 2022, there was no desire to buy at all. I remember that time vividly. There was just complete silence in the paid Telegram channels, where so-called experts ran their channels, charging for giving buy and sell signals to their subscribers. And at that moment, there was silence. In other words, it was crypto winter. No one was making any trades. Honestly, there was no volatility at all. And now too, as I understand it, no one really feels like buying. But nevertheless, as statistics show, that's exactly what you should be doing. That's why this particular metric is perfect for those who are looking for the right time and answer to the question of when to buy and when to sell. Sell in the distribution zone, buy in the buyer's zone. This metric does not indicate a specific entry point. It shows the zone where you need to use other metrics to find specific entry points. But simply understanding the zone already points us in the direction we should be looking for trades in which direction. So if the AWG is at 0.5 and you have the option to wait for either a short setup or a long setup, then of course it makes more sense to wait specifically for the short setup, because that would be at the beginning, so to speak, of a short trend. The only danger is entering a bit too early, because the zone, I repeat, does not determine the entry point. It determines the direction and timing. It kind of tells you that now is the time to work short. But with the help of other metrics, we find precise entry points so that we don't end up entering at the very beginning of the seller's zone, and then the market grows by another 20% before it actually starts to decline and decline for a long time. That's why this metric is fundamentally important for investors and it should be used. Now, regarding the comment that this is supposedly RSI, no, RSI has a completely different formula. RSI is calculated exclusively from market trades, and market trades are those that have already been executed. In other words, what we see on the chart is the past, yes, the past of trades that have already taken place. But limit order metrics show us the future, where algorithms place a large number of, and most importantly, synchronized limit buy orders across all coins. Not just for one coin, but synchronously for all of them. Because as you've noticed, when the market falls, it all falls together, right? And of course, this process doesn't happen because people are making trades manually, but because algorithms are executing the sales. Therefore, if all coins are being dumped at the same time, it means there was preparation for this. Preparation to dump them, meaning they were distributed in advance. And right here, you can clearly see that they were distributed in advance, and only after that did the market return to the buying zone. That's the overview for AWG. That's regarding the 60%. As for functionality, yes, we also have intraday trading, specifically the 15-minute depth, which I use and it performs quite well. But since this depth uses a finer calculation, the extremes also change depending on the market phase. What does this mean? For example, from 2019 to 2022, we had excellent entry points into the market when AWG 15% reached, as we can see, 196. For example, from the middle of 2022 to 2025, up until November 2025, we had a range that I have now marked. And for instance, in 2026, again, the range started to change, and the good entry points are now those values that I have just highlighted. Why does this happen? Because after all, there is shallower depth and a different amount of money on the exchange. But the key point is that the depth is shallower, so the algorithms change, and this is more noticeable at lower depths. Accordingly, at 8%, this will be even more noticeable. Well, yes, at 8%, there is even some correlation with the algorithm that was used at the 15% depth. For example, let's mark these levels now. Yes. Well, something like that, basically, yes. In this way, at an 8% depth, we can find entry points. If I switch to the 4-hour time frame, we'll see that, indeed, when the delta at an 8% depth reaches the marked level in 2026, this serves as a point to enter a long position. Yes, all these spots are places where we can buy and, accordingly, sell at a higher price. Understood. Let's sum up the conclusions. In this review, we took a detailed look at the AWG metric. In the previous review, we examined the bid-ask metric, and in the following reviews, we will go over the remaining metrics. After that, we will start identifying presets and some trading solutions that each metric offers in real time. That's all from me for now. Subscribe to my Telegram channel, where you can learn more about the Trading Platform Pro service and connect to it. That's all from me for now. Thank you all. Goodbye, everyone.